We're analyzing Alibaba, stock ticker symbol BABA, BABA, to see if it's a great business on sale. To determine if it's a great business, we're using the Select 6 analysis. The more metrics it checks out on, the more likely it is to be a great business. Then we're calculating the intrinsic value of Alibaba and comparing it to the current market price to see if the company's on sale. After, we're giving a final rating to the business when analyzing Alibaba for your portfolio. Before we get into these valuable metrics, let's understand Alibaba's stock performance. Alibaba recently announced they're splitting their business into 6 independent segments. Their stock price has increased since that announcement. Currently, Alibaba trades for $102.74 per share. In the last year, their stock price is down 4.5%. Even with all the press about this business, that's actually outperforming the S&P 500. In the last 5 years, Alibaba's stock price is down 42.5%. And going back to when the business was publicly listed a little over 8.5 years ago, Alibaba's stock price is up just 12%. That's compounding at a rate of just over 1% annually. Alibaba currently trades $20 below their 52-week high. They're up more than $40 from their 52-week low. 2.5% of their shares are sold short. Alibaba is one of the largest businesses in the world. They have a nearly $266 billion market cap. Learning more, Alibaba is the world's largest online and mobile commerce company as measured by gross merchandise volume. It operates China's online marketplaces, including Taobao and Tmall. Alibaba's China Commerce Retail Division accounted for 67% of its revenue in the year that ended in March 2022. Additional revenue sources include China Commerce Wholesale, International Commerce Retail and Wholesale, local consumer services, cloud computing, digital media and entertainment platforms, Cainiao logistics services, and innovative initiatives and other. The company was incorporated in 1999 and is based in Hangzhou, the People's Republic of China. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are 2 key reasons for this. The first is over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. The second is the average publicly listed business earns about a 7% return on capital. By asking for a benchmark that's 14% or greater, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Alibaba's return on capital has declined over this time. In their most recent fiscal year, the company earned just an average return on capital. And when we average out their returns in the last 5 years, Alibaba earns about a 10.5% average return on capital. While that is several percentage points above the returns of a typical business, this is down from that benchmark we were looking for. So this is an X on metric number 1. Next, we're looking at a high-level overview of the growth of their business. We want to see revenue, net income, and free cash flow growth in the last 5 years. We'll be including their last 12 months worth of numbers in our calculations here, and this metric is all or nothing. All of these have to be up for this to be a check. If even one of them is down, this entire metric will be an X. In the last 5 years, Alibaba has tripled their revenues. Their net incomes are down, especially in their last 12 months. This is due to a large increase in their interest expense, and they also had a significant loss on the sale of an investment. Those are 2 points you'd want to dig in and learn more about. And in this time, their free cash flows are down 7.5%. Because their net incomes and their free cash flows are down, this is an X on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years for Alibaba. Their earnings are down in this time, and Alibaba has diluted existing shareholders slightly by issuing 2% additional shares outstanding. With both of these factors at work, their earnings per share have decreased in this time frame. This is an X here on metric number 3. So far in our first 3 metrics, we're not starting off so hot for Alibaba, and we're still looking for our first check of the day. Metric number 4, we're looking for free cash flow per share growth in the last 5 years for Alibaba. Similar story here to their earnings. Because their free cash flows are down and with the company's slight shareholder dilutions, their free cash flows per share have decreased in the last 5 years. This is another X on metric number 4. Recapping where we stand currently, in our first 4 metrics, we are 0 for 4 on Alibaba so far. Can the business turn things around? Metric number 5, we're evaluating how the business uses debt. We don't want to be investing in overly levered businesses. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced in their last 5 years. Alibaba has had negative net debt in all 5 of these years, meaning that after paying off all of their debt, the company is actually left over with a cash cushion. They've significantly increased their cash cushion over this time. time. Alibaba ended their fiscal 2022 with $44 billion in cash on their balance sheet. Currently, the business has $47.5 billion in cash on their balance sheet. And in the last 5 fiscal years, Alibaba has produced $98 billion worth of free cash flow. In absolute terms, that's a huge amount of free cash flow. That's also a lot relative to their total enterprise value, and it's great to see this strong cash cushion for the business. This is our first check of the day on metric number 5, and it's a pretty massive check at that. Even with their free cash flows down over this time, Alibaba has produced $15.6 billion of free cash flow over their last 12 months. In absolute terms, that's still some of the largest free cash flow production of any business in the world. Metric number 6, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may provide a slight risk premium to the yield of the 10-year treasury, and it may offer a reasonable starting point for a fair value of Alibaba. Alibaba has a $236 billion total enterprise value. This takes into account both their market cap and their net debt position, which as we learned was negative. It gives us a perspective of the economic reality of Alibaba that's more similar to as if the company were a private business. We learned in our previous metric that Alibaba has produced $98 billion in free cash flow in the last 5 years, meaning in an average year the company produces about $19.5 billion of free cash flow. When we divide their $19.5 billion of their average free cash flow by their $236 billion total enterprise value, that gives us about an 8.3% average free cash flow to enterprise value yield for Alibaba. And on a current basis, Alibaba has produced $15.6 billion of free cash flow in their last 12 months. When we divide that by their $236 billion total enterprise value, that gives us about a 6.6% current free cash flow to enterprise value yield for Alibaba. Both on a current and an average basis here, this looks like this is above that risk premium compared to the 10-year treasury, and this is a check on metric number 6 for Alibaba. Just because it's the case doesn't mean you're going to run out and go buy the business. This is not a buy or sell recommendation of any security, and it's not financial advice. It's interesting to see that even though Alibaba started off so poorly with our analysis, they're really picking up strength here. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Alibaba, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Alibaba. A discounted cash flow model is based off the predictability of a company's free cash flows. Alibaba has had a moderate degree of business predictability in its past. That's no guarantee for the future, however. A discounted cash flow model is just like any other model in any other discipline. Its outputs will be dependent on its inputs. Here we're starting with an average of Alibaba's free cash flows in their last 3 years. Then we're using historical growth assumptions for how the business has grown these in the past in order to project these into the future. It's up to you to do your own homework here to figure out whether or not these are accurate and applicable going forward for Alibaba. Assuming they grow their average free cash flows at a rate of 11% annually for the next 10 years, then that this growth would be cut in half for the 10 years out from there, and they'd be growing at 5% annually. Adding in their tangible book value, which gives us an estimate of their tangible net worth. If we are seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, then it looks like at today's valuations of Alibaba that a potential fair value for the business is around $141 per share. That's a little over $40 above what the business's current stock price is at. Keep in mind the importance of doing your own due diligence here. Again, Alibaba has had a predictable business in its past. That's not a guarantee for the future. It's very important to understand this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with your financial advisor. In just a minute, we'll talk about our final rating for Alibaba, but we have to address something first. What are some of the qualitative aspects of this business? Starting with some of the qualitative aspects supporting a potential long thesis for Alibaba, Alibaba's Chinese commerce margins were higher than JD and Pinduoduo's for 2021. Number 2, core annual active users on Alibaba's China retail marketplaces had a retention rate of over 90% for the year ending in September of 2021. Number 3, gross merchandise volume per annual active user was 883,000 Chinese yuan for the year ended in March of 2022. This was higher than the 3,200 Chinese yuan for Pinduoduo and the 5,900 Chinese yuan for JD.com. For some of the key qualitative points supporting a potential short thesis of Alibaba, number 1, any internet companies with traffic like Douyin and Tencent can enter the e-commerce space due to its low barriers of entry. Douyin has gained market share in the apparel and beauty space against Alibaba. Number 2, expansion into non-physical goods marketplace businesses and other regions lead to lower margins, and the timing of profitability of these businesses is potentially unknown. Number 3, expansion of other e-commerce players could slow Alibaba's growth. Pinduoduo's active buyers have started to exceed Alibaba's since December of 2020. There you have it for a balanced perspective of some of the qualitative aspects of Alibaba. Now it's time for our final rating of the business. In analyzing Alibaba's stock ticker symbol BABA, we learned that the business earns above average returns on capital, but those were below the benchmark we were looking for. While they've tripled their revenues in the last 5 years, their net incomes and their free cash flows are down. They've slightly diluted existing shareholders, so they're down on a per share basis as well. The company has a cash cushion of nearly $48 billion on their balance sheet, which in absolute terms is massive. They've also been strongly cash flow generative in the last 5 years. On both a current and an average basis of their free cash flow to their enterprise value yield, that looks like that's giving a risk premium compared to the yield of the 10-year treasury. When we performed a discounted cash flow analysis of Alibaba, if you've done the work and you believe those historical growth assumptions, it looks like from today's valuations of the business, if you were seeking a 15% rate of return, that an estimate of Alibaba's fair intrinsic value is around $141 per share. It's worth reiterating this analysis is not financial advice and it's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. With all of the factors of our analysis in mind, it looks like Alibaba's a potential strong candidate for further research, especially as the business picked up steam as our analysis went on. I'm happy to make this updated analysis of Alibaba. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to take a look at next time. Thanks for learning about Alibaba with me, and have a great day.